This one's for all the business owners out there. 6 profit extraction strategies that I will explain and outline. I'm not too sure yet how much detail I'm going to go into, but I hope after this video you get a great understanding as to the 6 different methods that you can look towards, the tax implications in relation to them, and towards the end we'll discuss other methods that we can explore, such as the introduction or the insertion of a holding company. Now, before we go on, don't forget to like, comment, share, and subscribe. My name is Omar Aswat. I am a chartered tax advisor. This video is brought to you by Aswat Tax. The first two you'll know about. Okay, you'll know about the first two, salary and dividends. Okay, your accountant's probably mentioned to you, salary up to personal allowance, top up with dividends. That's like the standard typical scenario. And we'll go through salary first. So in terms of salary, there's different ways. So some accountants advise up to the personal allowance level, which is currently around 12,570. Some accountants advise up to the NI threshold, which is around 9,500. So therefore you're not paying no national insurance at all. And then others will have a mix. And I think it's difficult to say, as in, don't take this as formal tax advice. Each and every individual circumstance needs to be looked at on a case-by-case basis. That's the case with everything in relation to taxation. So, for example, even when it's inheritance tax planning, there's many ways that we can explore, but which route that you need to take, that's quite specific, right? And that's where we get involved and provide our bespoke service. Same with extraction strategies. So when we're looking at salary, we have the key elements that we need to remember is that so effectively you have the company and yourself, two separate legal entities. You have the company and yourself. So you might be 100% shareholder and director of the company, but you still treated as two separate legal entities. So the company's funds need to be extracted to you as an individual in your personal capacity. So the salary moving over to you as an individual is an allowable deduction for the company for corporation tax purposes. I hope that makes sense. I hope that's clear. So effectively, there's a saving of 19%, potentially 25%. Why? Because we know corporation tax rates have gone up this month, 1st of April for companies, to 25%. It was 19%, and it's still 19% for companies with profits of less than £50,000. For profits between 50k and 250k, it's a marginal sliding basis, and profits over 250k is 25%. So effectively, any salary withdrawn from the company through PAYE, so you have to set up the PAYE system to begin with, will be deductible or fully deductible for corporation tax purposes, saving potentially 25% taxation. However, when it comes then to the hands of the individual, which is you, the business owner, as an individual, as an employee of your company, then of course that's taxed under PAYE, and there'll be income tax payable if it's not already covered by your personal allowance. There'll be national insurance contributions, which will be class 1 for you as an individual, and class 1 primary for you as the individual, and class 1 primary for you as the individual, and class 1 secondary for the company, which is at 13.8%. I think I need to slow down. So that's income tax and class 1 NICs. Now, one would say, okay, dividends are better. Why? Because there's no national insurance contributions, and that is the advantage, or one of the advantages of dividends. However, the disadvantage of a dividend is that it's not tax deductible. So we'll come to that. But basically, reasons why you'd want to take out a salary as well as dividends. One is that it's allowable deduction for the company. Number 2, it counts towards your pension input for pension purposes. So for pension contributions, you have the amount of tax relief you can gain on your pension contributions is restricted to, it's either 3,600 or your pension input, and salary, trading income, and income from furnished holiday lets, those count towards your pension input. Dividend income, property income does not count. And number 3 is that the salary counts towards your state pension contribution purposes. So it's treated as a year for state pension purposes. So it's counted as a, what's the word? I haven't really made detailed notes on this. Counts towards your record for state pension purposes. Okay. Disadvantages are that, excess salary, we're being taxed then at 20% or 40% or even 45%, depending on how much the salary is. And also you are taxed at source. So PAYE, taxed at source. No such thing as payments on account or self-assessment. It's just simply you're treated as an employee of your limited company. Number 2 is dividends. Now, we'll explain dividends on its own, but I'll keep referring back to the pros and cons, or the advantages and disadvantages against the salary. Dividends are paid out of distributable reserves. And what that means is that they are paid after tax profits. They are paid from after tax profits. Therefore, what I just mentioned, dividends are not deductible for corporation tax purposes. So for salary, let me just explain to you. You have turnover, then you have cost of sale, you have gross profit. Okay, gross profit is here. Then you have your expenses, and your salary comes within these expenses, directors' wages. And then you have your net profit, and your tax is paid on net profit. Hope that makes sense. Dividends is turnover, gross profit, expenses, dividends are not there, net profit, tax payable. Then you have your bottom line is after tax profits, and whatever that figure is, that's where dividends can be paid out. So you need to be careful of issuing illegal dividends as well, because some business owners, they just keep taking dividends, but there's no profits to take them from. There's no reserves, so you need to be careful. And that's the disadvantages. So you're not saving any corporation tax. However, the advantages are that dividend income tax rates are lower than the salary or the employment income tax rates. For example, we have, for dividends, we have 8.75%, 33 point something percent, and 38.1%. So that's lower than 20%, 40%, and 45%. So lower income tax rates. Number 2 is no NICs, so no national insurance contributions on dividends. And the third advantage is you also get something called the dividend allowance, which is currently sat at £2,000. So £2,000 is effectively at 0%. I wouldn't say tax-free. It's taxable, but it's taxed at 0%. This is all specific terminology when it comes to taxation. So the advantages over salaries we just mentioned, no NICs, lower income tax rates, and you have the dividend allowance. However, the disadvantage is that reserves have to be available, and you don't get a deduction for corporation tax purposes. Hope that's clear. Hope that makes sense. Is there anything else in relation to dividends? I mentioned illegal dividends. Yeah, I would recommend that you take into account dividend planning. So don't just go free flow and just start taking out dividends as and when. I think it's important to sit with your accountant or to sit with us as chartered tax advisors and discuss, on a live, ongoing basis, instead of end of the year you're starting to look back and you're trying to make changes. And it's good to be proactive when it comes to taxation, and especially when you're running a business. It's extremely important to be proactive. Number 3 is, so we've been through salary, dividends. The third method of extraction of funds from your limited company would be by way of loan interest. Okay, so if the company, so as I mentioned, 2 separate legal entities, you as the business owner, the shareholder, the director of X Limited, 2 separate legal entities. if you loaned funds to the company, so if the company owes you money, then it is possible for you to charge interest on that loan. Okay, and that will be an allowable deduction for the company. Why? Because it's loan interest, so the company owes you funds. You have to just think of it as if they've loaned money from a bank, for example, or from a third party. The third party would charge interest, right? And that would be an allowable deduction. So same way, you'll charge the company interest. It has to be, market value. Shouldn't be excessive, because then HMRC will start getting interested. But that's an allowable deduction for the company. And for you as an individual, that's reportable on your self-assessment tax return, taxable at income tax rates. Now you might be thinking, okay, salary was taxable, loan interest is taxable as well. What's the difference? The key difference is that there's no national insurance contributions, and also you have the starting rate band, or the savings nil rate band, which is there's two different things. But for example, if you're a basic rate taxpayer, the first £1,000 of interest, loan interest received, will be at 0%. If you're a high rate taxpayer, the first 500 would be at 0%. And if you're an additional rate taxpayer, then that benefit is not there, but you still don't pay national insurance contributions. Moreover, what we have is the savings, or the starting nil rate band. So if you have no other income, this is very unlikely to be the case, but the first 5,000 is at 0% as well. I think that's very unlikely, extremely unlikely. As in, it's not even unlikely, it's just, it'll defeat the purpose of planning for profit extraction of funds. So that's number 3. Number 4 works similarly, which is charging rent to the company. Now, again, this is a specific scenario. If, for example, you own a building personally in your personal capacity, so again, just keep thinking of it as 2 separate legal entities. You own the building in a personal capacity. You might own the office, you might own the warehouse, you might own the factory. Okay, but the company uses these facilities. So it wouldn't make sense for you to then just, for the company just to use it without gaining any benefit, right? So what you do as an individual is you charge the company market value rent. Okay, charge the company market value rent. Let's just say it's £20,000 per annum. The company gets an allowable deduction, £20,000, saving tax at 25%, which is a £5,000 tax saving. Is still taxable on you as an individual, which is reported on your self-assessment tax return as some sort of rental income. However, again, no national insurance contributions are payable on rental income. Moreover, this does not count as earnings for pension purposes. And also, just need to plan this. You just need to speak to a professional about this, because obviously we have something called business asset disposal relief. Now, the disposal of this building that's used by a trading company will be treated as an associated disposal, or will qualify potentially as an associated disposal for BADR. Therefore, CGT at 10% rather than 20% or even 28%. Most likely 20%. So you've got the 10% tax saving there, and that is restricted if excessive rents have been charged, or if rent has been charged. And the rent restriction was introduced post 2008, so it's relevant now. Also, one more thing I wanted to mention about charging the rent. Yeah, it shouldn't be excessive. It should be market value. You have to be clever about these things. You have to be balanced. If you start overdoing things, HMRC will obviously become interested, and that's extra headache. So it's good to be balanced and not excessive. That was number 4. Number 5 is you can withdraw a loan up to £10,000 completely tax-free from your company. So £10,000 loaned from the company to you as an individual. There's no P11D issues. There's no national insurance contributions. There's no income tax. However, the flip side is, this, sometimes, like when it comes to taxation, there's a benefit, but HMRC, they're not generous people, right? Or they're not a generous organization. They'll try to tax you in any way they can. So You just have to remember that if the loan is not repaid, then there's potential Section 455 tax issues. Reach out to me if you'd like to discuss that in more detail. Number 6 is just general items, so general extraction of funds or other benefits. For example, an electric car, for example, there's many benefits there. Trivial benefits. I don't want to go into too much detail, but I just want to make you aware that there are multiple benefits that you can benefit from, whereby the company pays for it and it's better than you paying for it as an individual. The main one would be an electric vehicle or a car generally. You just have to do what we do sometimes for clients is comparative calculations to see what's better. And I think that works well because you can see the longer term tax savings as well. So 6 items we discussed. Number 1 was salary. Number 2 is dividends. Number 3, loan interest. Number 4, rent, charging rent. Number 5, the interest-free loan up to 10K. And number 6, general or trivial benefits from the company. There are other methods that can be explored when it comes to being a business owner of a limited company. And this part should interest you, or you should listen carefully. And again, there's many angles that we can discuss, and that's why it's important for you to reach out if you'd like a one-to-one initial consultation where we can just get to know each other a bit more, see where we can help, if we can help to begin with, how we can help, and then take some steps going forward. So number 1 is I'll mention 2. Number 1 would be the insertion of a holding company. Now the reason why this is beneficial is because we mentioned that dividends are taxable, right? So if you have the company again, you as an individual, dividends being transferred to you as an individual is taxable. Income tax 7.5%, 33.75%, 38.1%. So if you are looking to extract large amount of funds, let's just say, like for example, I had one client, he wanted to buy a property. He had like about £500,000 sitting in the bank account of the business. He wants to buy a property. Now, the property was going to be worth about 260. So withdrawing £260,000 as salary is ridiculous. Okay, 45% tax. So you have to effectively withdraw about 400,000. No, you have to effectively, literally withdraw about 450 or up to £500,000 of salary, then pay the 45% tax, and then you're left with around £260,000. I don't even want to go into that because then you have to pay national insurance contributions, class 1, primary, secondary. That's just like the worst thing you can ever do. And also dividends, okay? You might say, oh, dividends are cheaper, this, that, £2,000 dividend allowance. That's no good in the grand scheme of things. So that's where a holding company, the insertion of a holding company can prove to be beneficial. Why? Because dividends between companies are exempt. So effectively what would happen is you have your trading company here, we'd insert a holding company on top. So the holding company becomes the parent, trading company becomes subsidiary, and any dividends going up to holdco is completely tax-free. And then if you want to buy your property, for example, you can buy it within holdco. Or we can also set up an investment company sitting alongside the trading company with the holding company on top, dividends going around, completely exempt. So massive tax benefits, massive tax savings. There's commercial benefits as well, which is you're de-risking, right? Because anything goes wrong with the trade, your property, your cash is all safe and secure. For example, many business owners, this might be you as well, you might have large amounts sitting on your balance sheet, large cash reserves, 100,000. I've seen 1.2 million. I've seen more than that as well. Now that's not safe because any litigation against the trading business will be a big issue, right? That cash or that property, that valuable property that you own, the warehouse, the office, whatever it is potentially under attack from banks, creditors, whoever, liquidators, the list goes on. So it's always good to have a holding company, especially if you're starting to make profits. It's extremely important to have a holding company inserted on top. So, you can put the valuable assets within holdco, the cash, the properties, the assets, the valuable assets. So it's safe from any litigation. As I mentioned, there's a dividend benefit. There's also the benefit where if you're looking to sell up in the next few years, then there's something called the substantial shareholding exemption, whereby potentially the disposal of the shares, I'm not too sure if it still looks the same, but basically what's happened is I finished recording the video. It came up to about 29 minutes. And then I looked at this thing here, and the green light was off. So I'm like, oh no, I hope it recorded. So it recorded till about 19 minutes. So I'm going to continue from the substantial shareholding exemption, which I was saying that, and stay tuned because we've got the SSAS pension funds coming up as well, and EOTs and lots of other interesting things. So I was saying that the substantial shareholding exemption is basically beneficial. Why? Because no tax is payable on the disposal of shares in the trading company. So the holding company owns the trading company 100%. Holding company disposes of trade co, no CGT payable. Now, if you think about it, that's a massive benefit. Why? Because let's just say, for example, we had the value of the trading company was £5 million. Now, tax on £5 million disposal of shares, 20%, £1 million tax. Okay, and okay, you'll be like, oh yeah, BAD or this, that, excellent, but that's still 10% tax on 5 million, which is £500,000. The disposal of shares by the holding company of trading company subject to SSE being available. Now, SSE is a specific area which we need to look at, and we can provide formal opinion on whether SSE is available or not. But effectively, your £1 million or £500,000 tax that was to be payable is completely tax-free. So that's quite beneficial, and that's quite that's an extreme benefit of, that's an excellent benefit of inserting a holding company. Another thing I want to mention is, like we have the trading company here. You might want to insert a property investment company alongside the trade co with the holding company on top. Now you just have to be careful sometimes, because many advisors advise that that's the best way, but sometimes there's the risk of diluting the trading status of the group as a whole. And that's where we can potentially, instead of the property investment company being a subsidiary of Holdco, we can potentially introduce an investment holding company or something called a linked investment company. It depends what you want to call it. And that can basically sit outside of the trading group, and we can call that the family, we can treat that as the family investment company. That's where dividends are transferred, completely exempt, right? And you make your investments into stocks and shares, crypto, or property. And that's where we can look to the inheritance tax planning, because obviously those assets are not covered for IHT purposes and the business property relief. So therefore, we'd have to look to do some IHT planning, and then that's when we can look at other wider aspects of family investment companies, whether we need to introduce trusts, discretionary trusts, blended approach. And that's completely a bespoke service that we can offer you as the business owner, because we I work very closely with many business owners, and it depends on what stage we come in, what stage they engage us. But I've literally worked with business owners from stage one, which is even prior to incorporating. So shall we operate as sole trader, partnership, LLP, limited company, all the way to the end where we have to start looking at IHT planning. So, I'll explain at the end exactly what we can do to help you as business owners and where exactly we can get involved. So we'll give you an idea of, how we can potentially add value to your business. And I think it's extremely important as business owners. I know how busy you are. It's important to have someone professionally managing your tax affairs, ensuring that tax risks are mitigated, maximum tax savings are utilized and explored, always exploring. Like if you have this sort of reactive approach instead of proactive, it's no good for anyone, especially for you as the business owner. There's so much different functions. There's so much going on. From a tax perspective, we can definitely look after it, from a proactive perspective, a bespoke perspective. Look, Mr. So-and-so or Mrs. So-and-so, we've identified this opportunity. Let me present it to you. We present it to you, if you want to go ahead with it. If it makes sense at the time, then we go ahead. Further benefits of a holding company is that we can, any losses between any of the subsidiaries can be offset against each other. So that's another massive benefit of a holding company group structure. The second point that I want to make is in relation to a SSAS pension fund. Now, this is, honestly speaking, in my opinion, unutilized, extremely unutilized. Many business owners are completely unaware of this massive, I keep using the word massive. What word should I use? Of this, it's just extremely beneficial. And when I start explaining to you even some of the tax benefits and advantages, you'll be like, Omar, get me onto this straight away, you know? So effectively, a SSAS pension fund, a SSAS, small self-administered scheme, it's a pension fund, it's a trust fund. So you know how, generally speaking, when you make pension contributions, you provide the funds to one of those massive providers, and then they invest the funds for you, and that's the end of the matter. You might get tax relief here there, but that's the end of the matter. The benefit of a SSAS, or the feature of a SSAS, is that you have full control over those funds. So effectively, you're managing your own pension pot. And I think many business owners, they like that element of control. And I completely understand, because me personally, I wouldn't want to just, start giving my money away to one of these providers. You never know what can happen, right? Obviously, you are covered certain 85,000, this, that. But I just personally, it's just a personal thing. So that control is where many business owners, they like the idea of a SSAS. And for example, now usages of a SSAS, what you can do, for example, is, okay, the immediate tax saving. I think that's what we're interested in right now. The immediate tax saving is the company. So we have the company. Now think of it like this. I kept using both my hands. I said the company and you as the individual business owner. Think of the SSAS as a third legal entity. Okay, so now the company will make pension contributions to the SSAS, let's say £40,000 per annum. The company will get a tax deduction for the pension contribution. Okay, so that's immediately saving tax at 25%, so a £10,000 tax saving. 40,000 at 25% is £10,000. That will pay for us, that will pay for our fee on implementing the SSAS twice over at least. Okay, so immediate tax savings. Not to forget that we can potentially make a contribution of up to £160,000 depending on your circumstances. That's something we need to assess and review. But £160,000 contribution deduction for the company, 160 at 25% corporation tax saving is £40,000 in the first year alone. So massive tax benefits immediate. That 40,000, that 160,000, or whatever it is, there might be 2-3 different direct shareholders. The more direct shareholders, the more funds we can introduce into the SSAS pension fund. Those funds now, you can literally do whatever you want with it. It can just sit there. Okay, you've made your benefit, you've saved your tax, 25% corporation tax, the funds are just sat there. Or you can start investing into stocks and shares, crypto, or you can buy property, commercial property. Residential property we need to look at in more detail. But a key benefit of a SSAS is there's no tax payable. Now think about it, no tax payable, no income tax, no corporation tax, no capital gains tax, no inheritance tax. So you're also removing value away from your estate for IHT purposes. A common feature or a common sort of transaction or structure that we see or we advise on is that the business owners, they want to, so we have many business owners, they want to purchase commercial property. Now, what we can do potentially is purchase the commercial property within the SSAS itself. Why? Because then, as we mentioned, point number 4, charge rent to the company. The SSAS owns the commercial property and charges rent to the company. The company, let's just say market value rent is £30,000 per annum. The company get an allowable deduction, as we mentioned. And what did we mention before? We said that the individual, when the individual owned the property, in his or her personal capacity, the individual, yes, no NIC is very good, but they still had to pay income tax, right? 20, 40 or 45% set via self-assessment. But the beauty of the SSAS is that the SSAS will receive the £30,000 or whatever the market value rent is, and no tax payable. No tax payable at all. So you're getting a deduction from one side, and this is a rare circumstance, very rare circumstance. You know, HMRC, they try to take as much money as they can. So usually when there's a benefit somewhere, then there's a negative somewhere else. So here is a rare instance where you get an allowable deduction for the company and the opposite party is paying no tax. This is very, very rare. So must be utilized. Another scenario that we see is that, okay, the business owners, they want to utilize the tax saving immediately, which is the pension contribution going over into the SSAS. And then half of the funds can be loaned back to the company. So you still have the funds available within the company that can be used for working capital purposes. Many, many benefits of a SSAS. It just depends on your structure. It depends what your goals are, what your plans are going forward, who else is involved, you know. So it all needs to be looked at. As I say, we work with business owners in different stages of the cycle. So literally from start to finish. And I'll just quickly explain to you where and how we can help. So for example, at the start, even prior to any business, we can advise on the method or the mode of operations. So as I mentioned, sole trader, partnership, LLP, limited company, what's more beneficial? What do we recommend based on your circumstances? Then once the business starts, you know, we have incentivizing employees, for example. So we have the EMI share option scheme, CSOP. We can implement these into your company to then incentivize key members of staff, for example. We can ensure maximum capital allowances are claimed, unlock valuable tax relief such as R&D, patent box relief. You know, we can constantly be assessing your situation, see where we can save some tax, where we can access valuable reliefs. If you want to start investing in property, for example, or you want to start, you know, branching out, that's when we can restructure and bring in our expertise to set up a linked investment company, let's say, or insert the holding company group structure. Restructuring on a general basis, for example, I'm looking at a demerger case right now where two partners, they started about 15 years ago, and you know, it's amicable, there's no issue. So sometimes we do come across where, you know, there's family fallouts or business partner fallouts, and we need to demerge the businesses. So you already have a group structure, but we need to demerge, and that's a complex and complicated process which takes at least 4 months. We give a timescale of 4 to 6 months. But yeah, this particular case I'm looking at is completely amicable, and you know, these things happen in life. So for example, in this scenario, is one of the partners is just turned over 50, and one of them is still 35, 40. Okay, so they've got different goals in life right now. They want to go their separate ways, completely fine. Demerge the business, you know, transfer of trade and assets, depending what your situation is. And then that's when we move on to succession planning. So what are your plans for the future? What are your plans with the business? Are children going to take over? If not, are you going to sell? How are you going to sell? Is it a sale of shares? Sale of trade and assets? Is it a management buyout? Sale to a third party? You know, all these things we can advise on. And recently, quite popularly, we have the sale to an EOT. EOT is an employee ownership trust. Now, I'll just quickly go into the EOT. Why? Because there's massive tax benefits and commercial benefits as well. So the commercial benefits are, for example, you can literally get market value for your shares, whereby if you sold to a third party, you know how it is, purchaser comes in, due diligence, smash the price down, constantly smashing the price down. And, you know, this is a sale to an EOT. So effectively, you are on both sides of the spectrum. You are both the purchaser and the seller, if you really think about it. Check my videos out in relation to EOTs. The tax benefits are crucial, significant. I'll use the M word again one last time, massive. We have, still on, we have the sale of shares to an EOT is completely CGT free, completely tax free. Now, we mentioned earlier on the holding company disposing of shares in the trading subsidiary where we access SSE and is completely tax free, right? I said O, 0% O for Omar. Completely tax free. But what you need to remember is, okay, it's tax-free, but now the funds have been received by the holding company, right? So sale to a third party pays funds to the owner, which is the holding company. The funds are still stuck there. So we need to go through extractions, salary, dividends again. We're going through the same process, and at some point, tax will be payable, whether it's income tax or you might go through the liquidation route, CGT, BADR, still 10% tax payable. But the sale to an EOT allows you to get the funds in your hands, in your personal hands, with no tax payable. Imagine, that is a massive, massive tax benefit. The other tax benefit is, once it's employee owned, then employees can receive bonuses up to £3,600 completely tax free as well. So very popular. The legislation was drafted in 2014 and becoming increasingly popular just because of the less headache. You don't have to go through the legal processes, headache of a purchaser. So yeah, you can have a chat with us about EOTs if you like. And then after that, you just have to remember that those funds received, so let's just say it was a sale to a third party or a sale to an EOT, you still have received £5 million cash, let's say, for example. Now, the value of that 5 million was in the trading company before, which is covered by business property relief for IHT purposes. So therefore, we had no IHT problem there. But now when you hold the cash personally, you have a 40% problem, okay? 40% is £2 million. You have a £2 million problem. If I'm just continuing the example of 5 million. And that's where our expertise is in IHT planning as well. We can, family investment companies advise on, how to best manage the funds, EIS, SSAS investments, introduction of trust, blended approach, discretionary trust, passing on wealth to the generations tax-free, mitigating, sometimes completely eliminating IHT. So it's the whole process that we can look after. So do get in touch with us. I'd be very happy to have a chat with you, especially if you watched till this far, you have an interest, you want your business to do well. As I say, it's always good to have chartered tax advisors on board, and we are on board with many family businesses. We'd definitely be happy to have a chat. Initial consultation, nothing, no strings attached. Just have a chat, get to know each other, see where we can help, if we can help, if we can, how we can help, and take it from there, build a relationship. For me, it's not about just offering you a proposal and then just taking providing the scope of work, fee quote, taking the fee from you and then run away far away as possible. It's about building relationships, and I know as business owners it's important to have someone that knows what they're doing, and as I say, we can assist in the whole process, including the IHT element as well. I hope you found that beneficial. I hope you found that useful. We talked about salary, dividends, loan interest, charging rent, pensions, a loan, £10,000, trivial benefits, and then a holding company and a SSAS pension fund. I hope you found it informative. Don't forget to like if you did, thumbs up always. Comment with your thoughts, any questions that you have down below. I'll get back to you. The link to book a call with me is down below as well. My name is Omar Aswat Tax. So my name is Omar Aswat. The firm name is Aswat Tax. You see the play on words there. Aswat Tax, Chartered Tax Advisors. My email address is down below. And don't forget to share with other business owners, your network, and subscribe to our channel where I'll bring you loads more interactive and informative videos. Speak to you soon. Don't forget, the taxman is always after us, so we need to, work together and, come to some sort of solutions.